Good morning and welcome. I'm Mackenzie Babb, External Affairs Director for the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. For those who may be unfamiliar, the Kenan Institute is a nonprofit, nonpartisan business policy think tank driving research at the intersection of business and society. That research ranges from rural economic development and the business of health to tax policy and stakeholder capitalism. And today's conversation will mark the first in a new series of monthly press briefings we'll be offering on the state of our economy. This and future briefings on the topic will coincide with the release of the Labor Department's monthly jobs report, which typically does fall on the first Friday of the month. Today's conversation will be led by Kenan Institute Chief Economist Gerald Cohen. Dr. Cohen has worked in both the public and private sectors, serving during the Obama administration as Deputy Assistant Secretary for Macroeconomic Analysis at the U.S. Department of Treasury. Prior to that, he co-managed a global macro fund at Ziff Brothers Investments. Dr. Cohen holds his undergraduate degree from MIT and his PhD in economics from Harvard University. Before I hand things over to Dr. Cohen, I'd like to provide a bit of a roadmap for how today's conversation will go. For the next 10 minutes or so, Dr. Cohen will deliver his analysis of the jobs report findings, including what the data tell us about GDP growth and inflation, as well as what he anticipates may be coming next from the Fed, with an eye toward what it all means for business. We will then spend the second half of our time together fielding your questions, which you are welcome to submit at any time using the Q&A function you can find at the bottom of your screen. So that we may prioritize questions from the press, please plan to include your name, title, and organization with submission. And for those joining us by phone, you are welcome to email your questions directly to me. You can email me at mackenzie_babb@kenan-flagler.unc.edu. If you can remember all that, you're already ahead of the pack. We'll aim to get to as many of your questions as possible before we wrap at 9:30 Eastern. With all that said, it is my pleasure at this time to hand things over to my friend and colleague, Kenan Institute Chief Economist Gerald Cohen. Dr. Cohen?
Good morning, everybody. Good morning, Mackenzie. It's great to be here. I just want to tell everybody that we are doing this kind of a first take. So data has just been released, and so some of this is really kind of as quick a first take as we can do. So look forward to your questions, and we'll work through the data together. Let me start by sharing my screen. We had a healthy jobs report this morning with 428,000 jobs created in the month of April. That was stronger than expected, the 380,000 that were expected. There were some downward revisions in the previous months. The downward revisions netted 39,000. And if you compare the revisions and what was the 380,000 that were expected, though, the report was stronger than kind of expectations plus revision. So the number of jobs in the economy were on net 9,000 more than what people expected if you incorporated the revision. So what I mean is that the economy was, if people expected 380,000 jobs in the month of April, we got an equivalent of 389,000 jobs if you include the revisions and the actual number and the revision. So markets should take that as a strong number. At the same time, the unemployment rate was unchanged at 3.6%, which I'll get to in a second, versus the expectations of 3.5%. So that was kind of a slight offset, but the overall report was quite strong. In terms of this, so this chart that you're seeing, the bars are the job numbers on a monthly basis. The orange line is the 3-month moving average. The 3-month moving average is slowing a little bit, but it remains at a very strong pace. To put it into perspective, as the economy gets back to its kind of normal stance, given a population growth, we should be expecting roughly 100,000 or even less job growth. But, and this is an important but, we are still below our pre-COVID peak. So this chart illustrates that employment is now, even with the strong numbers and the number of jobs out there in the economy, is still 1.2 million smaller than the pre-COVID peak. So that's an important aspect. So you could say, well, we're creating jobs that are faster than population growth, but though we are still below, but we still have a gap to make up. So until we make up that 1.2 million gap, you would expect to see strong job growth. In terms of the sectors of the economy, where in terms of what sectors grew, manufacturing growth, growth in the manufacturing or jobs in the manufacturing sector was strong, up, just get my numbers, 55,000 for the month of April. That's an acceleration. Meanwhile, you saw a meaningful deceleration in construction jobs. There were only 2,000 construction jobs created in the month of April versus 20,000 in the previous month. As we've seen an increase in mortgage rates, and as we would expect to see the jobs in construction slowing, and in some respects, this is kind of what the Fed wants, as Jay Powell talked about on Wednesday. He said, what we're trying to do is get demand and supply back in balance in terms of the job market, and a key is the job market. And this is the sector that you're likely to see. So this slowdown in construction is what I would say positive news for the Fed. And we wouldn't be surprised to see actually some declines in the construction sector. Meanwhile, in the service sector, which produces most of the jobs, 340,000 jobs were created, strong numbers in retail, strong numbers in the hospitality and leisure sector, which, as I'll illustrate shortly, has the biggest gap and is the biggest driver of this gap that you're seeing in this picture. There are currently 1.4 million jobs short we're still 1.4 million jobs short in the hospitality and leisure sector relative to the peak. And so in some respects, what this data is saying is that we've created more jobs outside of that sector. And so we're above the peak. And if you combine all the other sectors, it varies by sector, except for the hospitality and leisure, I think hotels and restaurants. So that sector remains quite weak, although you did see some strong data. Another indicator that we watch quite closely, and I'll illustrate it in a little bit, is the temp help, where job creation is leveling off. In terms of the unemployment rate, as I said before, the unemployment rate was unchanged at 3.6%. Expectations were 3.5, but that's effectively rounding error. But as you can see in this chart, we are essentially at a 50-year low in unemployment. The pre-COVID low of the unemployment rate was 3.5%, and that was the lowest number since December of 1969. So we're close to those lows, although the unemployment rate kind of masks some important issues in terms of people's participation or people coming back into the labor force. So what this chart illustrates is the blue line is the over headline participation rate, which is the number that people see on their screen or kind of note most closely. And that number showed a decline in participation from 62.4% to 62.2%. So you had people actually dropping out of the labor force, which is not good news. What we're hoping for is to see that number kind of rebound back to pre-COVID, or at least to get close to pre-COVID peak. So that's the blue line. The problem with the blue line is that number is being driven by a lot of that number pre-COVID is being driven by demographic forces, because as the population is aging, you're seeing people moving into, move out of participation. So as people become 55 or older, their participation rate declines. So in the orange line, what I'm doing is I'm illustrating the prime age participation rate, which is the participation rate of people who are in their 25 to 54-year-olds who are most likely to work. And in that case, the participation rate also edged down from 82.5 to 82.4. So that number is, again, it's the reverse of what we'd like to see. But as you can see in the chart, we're getting closer to pre-COVID levels. Another key headline is our average hourly earnings, and in this case, what happened was average hourly earnings for the month increased by 0.3% for the month, and is up 5.5% the year on year, which is the blue line. That generally should be good news. However, inflation remains higher, and you can see the headline CPI number, which is in orange, is growing over 8%. Although we anticipate that that we've seen the peak in terms of in terms of inflation, and so you're likely to see some slowing in, but still wages are growing much more slowly than inflation. So inflation adjusted, or real wages in economics parlance, remains below or a negative. So basically people's take home is less than what they're losing in inflation. So one of the challenges for the Fed is whether is that people will be asking for higher wages because of because their wages are growing less than inflation, and that trend remains. Another key headline that will come out is another key headline is the aggregate hours worked, which is the total number of hours worked in the economy. And as this chart illustrates, it is highly correlated with GDP. So there are two components to GDP growth: effectively people working more hours, and the productivity of those hours. And so you can see that that there is a very strong relationship. Aggregate hours worked for the month increased 0.4% in April, and are up 4.3% year on year, which suggests a healthy second quarter growth. If you annualize the hours number from the month of April, it's the first month of the quarter that we have, relative to the previous month, it's up at a 2.7% rate. So assuming that we get any productivity growth, that would imply that you'd see a strong rebound in GDP growth in the second quarter relative to the decline in the first quarter. Let me end with, well, I said I'm trying to keep it. Let me kind of point out a couple of things, and then we'll go to the Q&A. As I mentioned, since we talked about inflation, I just want to mention an area that we watch very closely in terms of the inflationary impact is other services, which is a sector such as business such as haircuts, where you see a very strong pass-through between the wages of workers and inflation. And so if Jay Powell is saying, look, I'm worried about wage growth past this wage price spiral, where strong wages lead to inflation and strong inflation leads to higher wages, this sector, other services, which think haircuts, is a good measure of the relationship between wages and prices. And what's notable is that wages and other services actually declined 0.3% on the month. Let me just double check that number. And are down, and you're seeing a deceleration in, it's the fourth consecutive monthly decline in wages and other services. And as the chart illustrates, you're seeing some slowing on a year-on-year basis. Finally, I just want to point something out that is really deep in the bowels of the report, which is that the Bureau of Labor Statistics asked the Fed about the number of people who are unable to work due to COVID. This number, unfortunately, it just got updated, so I just got a little text about it. But so what I'm showing you is the the March number, but the April number, which we'll send in your press packet, is 1.9 million people. So there are 1.9 million people who report that they are still unable to work because of COVID. And this goes back to that relationship with the labor force participation rate. So people are staying out of the labor force or not going back to work so there's still people in the month of April, or 1.9 million people, who are saying that we are not working because of COVID. So COVID is there. We're still seeing a long tail of COVID. Finally, and I do want to leave it for you to open up to questions. I wanted to show, what does this mean for the Fed? So all I'm doing is, this chart is just saying, let's take the relationship between the unemployment rate and the Fed. So the employment rate is the inverse of the unemployment rate. It's the share of people who are in the labor force who have jobs. So that number is 96.4%, given the 3.6% unemployment rate. And you can see that there's quite a strong relationship. And it's just a very simple relationship that, if I showed that if I asked my students, I would ask them to say, well, what are all the confounding factors? But there is a nice relationship between the unemployment rate or the employment rate and the Fed funds rate. And as you can see, given the very low level of the unemployment rate, even with all the confounding factors of the low labor force participation, it suggests that the Fed has a lot more wood to chop in order to get themselves back to some neutral rate where the economy, where they're slowing the economy and to keep inflation low. So let me stop there and open it up to questions.
Great. Thank you so much, Gerald, for that real-time set of insights. We know that the report just came out, so appreciate your quick turnaround on this analysis. At this point, we are going to start taking questions from our audience. As I mentioned at the top of our time together, you can submit those using the Q&A function at the bottom of your screen. I've seen a few come in. We're going to get to those shortly. For those who are joining us by phone, you are welcome to email me your questions. I'm again at Mackenzie_Babb@Kenan-Flagler.unc.edu. At this time, I'd like to pose our first question, which came in from Jason Parker at WRAL TechWire. Jason says, given that nationally and here locally in the Triangle, we're still experiencing a housing shortage, can you speak more about the relationship between rising mortgage rates and jobs in the construction industry? Wouldn't we want to add additional housing stock inventory as a mechanism to meet demand and stabilize housing market price appreciation?
Jason, that's a great question. And this is one of the challenges that the Fed is the needle that the Fed is trying to thread. So the Fed has a very blunt set of tools effectively affecting interest rates through raising the very short-term rate known as the federal funds rate, which is illustrated in this chart, or affecting interest rates by the size of their balance sheet through quantitative easing. And as they said, they're going to actually do quantitative tightening, where they're selling off their bond portfolio or parts of their bond portfolio. And one of the parts of their bond portfolio are mortgage-backed securities. So by raising interest rates and by selling mortgage-backed securities, they are effectively raising mortgage rates or raising the cost of money for mortgages or for borrowing, and thereby slowing the housing market. So when you look at the Fed's tools, what they do is they cause the most pain in sectors such as the housing market, in sectors such as the auto market, places where and in businesses and for business investment. So that's the only thing that they can really do to slow the economy. And yet, as you suggest, this is an economy in which there are housing shortages. So if we were back in 2008, 2007, 8, there was a housing glut. And so kind of raising rates was kind of working with what was wrong with the economy. In this case, raising rates is going to hurt the sectors of the economy that we kind of need to keep growing. But what they're trying to do is trying to have the demand weaken and have the supply continue to grow. Now, how that will happen, because supply is going to respond to demand, is challenging. But I think what the Fed is hoping is that the underlying demand that's there because of demographics or because of the housing shortage will continue to push construction going forward, but perhaps weaken demand enough so that prices won't continue to increase at a significant pace. I realize that that's not a great answer. And so perhaps what we will see is construction, to your point, may remain healthy, especially in areas where demand is quite strong. But it's one of our early warning indicators to say, okay, this is where you're seeing the impact of the Fed. So we might end up having the Fed crunch the area that we may not want from a long-term demographic standpoint or from a long-term kind of growth standpoint. But that's just a matter of them having a very blunt tool.
Great. Thank you so much, Dr. Cohen. Moving on to our next question submitted, we had one come in from Jeff Miller. Jeff poses the question, do we understand what types of fields and jobs the 1.9 million people who are still unable to work due to COVID are in?
We don't. I don't believe we have, I don't think we have a lot of data on it. I think we have some demographic data. And one of the places where you do see is that it's actually women. And I can show you, this is a slightly different cut on this data. So this is the kind of people who didn't look for work. And this is also the April number. The March number literally came in after the report I started talking to you. But you can see that women tend to be the harder hit than men, and that is because of caregiving. I mean, one of the things we suspect, I don't know, is because of caregiving needs. So you see those memes where the woman is taking care of the baby and on a Zoom call, and making lunch, and so the data is illustrative that at least or suggests that meme is correct, that women are just having a harder time getting back into the labor force because of COVID, because of uncertainty in caregiving needs or kind of needs for their household. I can look into it and get back to you in terms of who we can say more than just some general demographic general demographic trends.
Great, thank you, Dr. Cohen. Our next question that came in is regarding what a number of analysts have been talking about. Rebecca Mormino says, some analysts are talking about risks of a recession. Do you anticipate a recession?
We do not anticipate, or I do not, or we do not anticipate a recession. And I think that the challenges, and as illustrated by Jason's question, is that this rate hike is going to be impinging on parts of the economy, and the fact that the Fed is doing it so quickly puts a recession at risk. However, my favorite economic indicator, and so I carry it around in my back pocket just in case I get this question, is the spread, between 10-year and 3-month treasuries. This is it's a financial market indicator that where forward-looking financial markets are, kind of try to best to anticipate what's going on in the economy and what's going on in inflation. And the spread between the two, since I started studying it in the early 1990s, has been a perfect predictor of recessions. So you can see the blue line is the spread, and whenever it inverts or turns negative, a recession has been forthcoming. The timing is not perfect, or is inexact. I say roughly 12 months ahead. But in some cases it can be longer, and even one might say, well, it didn't predict COVID, but it did predict the COVID recession. And I would argue that's because that was a time when the Fed was raising rates, and they had raised rates enough, and you were starting to see and they ended up backing off on those rate hikes because you were starting to see a slowing in the economy. So I'm not saying that this measure predicts predicted COVID, but at least it predicted the recession that went along with COVID. And the fact that this is so positive suggests that the likelihood of a recession is very low. This is an indicator that I've been watching, as I said, for close to 30 years. And when I didn't heed it, I regretted not doing so. And so I'm sticking to my guns and saying, yes, there are reasons why, and many trusted analysts are saying, there's a 30% or higher, and some people are saying, some investment banks are saying there is a recession. But I'm going to stick to my guns and say, until this indicator inverts or we start to get negative job growth, which then I'm gonna stick to my guns that we're not going to have a recession in the near term.
Fingers are crossed. You can't
Yes,
fully
exactly.
see them because
Fingers
of my
crossed.
background, but my fingers are crossed. Dr. Cohen, we had a few questions come in via email, and I see one additional question in the Q&A. I know we're not going to get to all of them because we do have to wrap at 9:30, but perhaps we could do a lightning round question with this one that just came in from Peter Delena. How does the inflation situation in other markets like the EU compare to our situation, and how do you envision that impacting the U.S. economy? Perhaps we could do
very good question. So one of the things, lightning round is that people say, it's because of Fed and federal government being overstimulative, but the fact that everybody else has had similar bouts of inflation suggests that there's something else going on, regarding supply and demand dynamics. The euro area's inflation has been at a lower pace, but they are also, they've not had the jump in inflation that we've had, part of which is because their energy prices are much more, they have much higher energy prices because of taxes. So they don't see as much, they're less sensitive to energy, but that's just one of the aspects. But the fact that we're all dealing with this inflation suggests that, we really need to work out global supply chain issues. And by the way, the ECB is also talking about either raising rates or kind of again being less aggressive with their quantitative easing. So that generally, though, we are outside of commodities. Most of our demand is met by internal supply, and so generally the inflation pass through from places like Europe is extremely limited. Except, if you're going on vacation, that's where you feel it. But many goods, even imported from Europe and imported from Asia, are priced in dollars because we're the biggest market. So I wouldn't expect, the cost of BMWs or Volkswagens to rise substantially differently from the US because they are in intense competition with GM. So generally we make our own inflation, except energy and some, which is a global commodity. But so they're having a similar inflation, but it's not, the likelihood of it impinging on the US is relatively small. It's our domestic demand and supply to demand dynamics that is driving it.
Great. Thank you so much, Dr. Cohen. And I know we had another couple questions come in the Q&A. And again, I know that there are questions we didn't get to that came in via email. So I am so sorry for the questions we did not get to, but I'd like to thank Dr. Cohen so much again for sharing his insights. To those of you who submitted questions we did not get to, we would be happy to continue the conversation. You are welcome to email me, again, Mackenzie_Babb@Kenan-Flagler.unc.edu, or you can email my colleague, Rob Knapp, who invited you to today's session, Rob_Knapp@Kenan-Flagler.unc.edu. We would be happy to connect you with Dr. Cohen or any of our other experts to continue the conversation. Thank you again so much for taking the time to join us today. And we hope to host you again next month when we gather to talk jobs report, inflation, and the Fed once again. So again, stay in touch. I hope to see you in a month. And until then, take care.